Bloomberg Audio Studios.
Podcasts, radio, news.
The most profitable hedge fund strategy of last year was buying something a lot of people don't like thinking about: cat bonds. They have, unfortunately, nothing to do with cats. In this case, CAT is short for catastrophe, and cat bonds are for extreme weather events.
Cat bonds are only for very rare, very catastrophic events, whether it's California quakes or even a Japanese tsunami.
We talked about them with Gautam Naik, a Bloomberg reporter and editor based in London.
The way it works is that if a defined event doesn't occur, then the investor, they get to keep their money and they get paid a very handsome risk premium. If that particular catastrophe as defined does occur, they can lose some of their money or all of their money. So it's a big risk and it's a gamble against Mother Nature.
Gautam told us that while these bonds have been around since the 1990s, they've been growing in popularity recently. A record $16 billion in cat bonds were issued in 2023, bringing the total market value to $45 billion. Today on the show, how cat bonds went from a niche corner of the financial world to becoming one of the market's hottest items, and how the increasing risks from climate change might complicate that. This is The Big Take from Bloomberg News. I'm Sarah Holder. So Gautam, how do catastrophe bonds work?
So a catastrophe bond is a specialized form of insurance. So typically, an insurance company would issue a cat bond if it didn't want to take on the risk of a Katrina-like event occurring and destroying tens of thousands of homes and leaving the insurer on the hook for a huge amount of money. So a cat bond is a way to pass on this risk to Wall Street, which is not traditionally part of the insurance industry.
Catastrophe bonds are usually held for 3 to 5 years. And Gautam says the length is set that way for a reason.
So it's not for 10, 15, 20 years. That would be a huge risk. It's for a very narrow, specific time frame.
But even in that specific time frame, weather is notoriously hard to predict. Have you ever used a weather app? So Gautam wanted to understand how the people buying these bonds were deciding which disasters to bet against. And when it comes to cat bonds, there's no firm that's bought more of them than Fermat Capital Management. So Gautam went to Connecticut to visit them.
So, a typical hedge fund might have, marble floors and expensive art hanging in the on the walls and, might be located in central Manhattan. But Fermat is quite different. It's based in a pretty affluent town of Westport in Connecticut, but it's on a fairly modest street and opposite a car repair shop. If you enter the offices of Fermat, you basically find meteorology and weather journals, a lot of wonky literature in the reception area. You have a lot of whiteboards where equations and physics details are scrawled.
At the center of all these whiteboards is John So, Fermat's co-founder and managing director.
He has a background in biophysics, and I think he's really used that scientific and mathematical acumen to good stead, and sort of created his own models and his own mathematical techniques.
One of So's earliest finance jobs involved creating unique derivatives to cover seemingly random events.
So, for example, a charity that was organizing a golf tournament and would give somebody a car if someone hit a hole-in-one. What is the likelihood of that hole-in-one occurring? And if it does occur, the charity might be wiped out. They'd be on the hook for, losing the car or prize money. So you would want to buy insurance against that happening. So he would calculate that kind of risk and create a derivative product that would, protect the charity in case someone did hit that hole in one.
So told Gautam that when he started Fermat with his brother in 2001, he set out to build a science-based model that would weigh the probability of a natural disaster against the returns on a cat bond. And his method starts with gathering a bunch of meteorological data.
There are specialized companies that take a lot of the meteorological data and crunch it, and they come up with sort of a magic number. What is the estimated loss of a particular event? So let's say a California earthquake. What is the likelihood that a particular earthquake could occur in a particular year in a particular area of California where there are a lot of expensive homes? Well, you'd have to know your plate tectonics. You have to understand the history of earthquakes. You'll have to look at the data that shows who has built homes in which area. And there are specialized companies that provide this kind of information. So what John So does is he buys these models from these companies, but then he does his own calculation on top of that. He adds his own magic sauce to refine it so that he can sort of beat the cat bond market and perhaps beat other investors.
And this magic sauce includes more unconventional methods, like watching hours of film of California wildfires to understand where they're happening and how they're spreading. Anything that might help refine the data coming in. And that also includes a model that has made Fermat's betting approach unique, one that borrows from, out of all things, airplane physics.
He plotted one curve, which was the probability of a catastrophe against the potential losses. And then he plotted another line which showed how much profit he could make at different levels of risk. And when he put those two together on a piece of paper, they looked like the cross-section of a wing. Once he realized, whoa, this is just like a wing of an airplane, I can look at the physics of lift to compute the risk and reward at every point on those curves. And once you calculate that, you have a slightly better idea, or quite a better idea, of whether to invest in a particular set of bonds or not.
But like other cat bond investors, a key part of So's strategy is to diversify. Fermat's bonds cover properties from Florida to New Zealand.
So a typical hedge fund would buy 100 or 200 different cat bonds. One would be, say, for a typhoon in the Philippines. One would be against a tsunami occurring in Japan. One would be against a wildfire in California. Now, the likelihood, statistical likelihood of several of those natural disasters, which are down to Mother Nature, really, they're pure luck, right? The chances of those occurring in the same year are very, very low. So even if one or two or three get triggered, these investors have positions in a whole bunch of other cat bonds that don't get triggered, so they don't lose money on those.
At Fermat, So has taken cat bond trading to the next level. The company accounts for a quarter of the entire cat bond market and had returns around 20% in 2023. That's way higher than the average 8% returns brought in by the rest of the hedge fund market. And So is really confident in his calculations. Here he is on Bloomberg TV.
Is the market or cat bond prices a better predictor of where hurricanes might make landfall or perhaps the kind of damage they may cause than an outfit like the NOAA?
Right. I think that they're as good a predictor as you're going to get.
After the break, what happens when the disasters cat bond traders are betting against get more unpredictable? Hey, we're back. Before the break, we were talking with Gautam Naik about catastrophe bonds and the man at the center of the firm that owns the most of them, John So. With the weather getting more unpredictable and extreme, I wanted to know, what does that mean for So's models? Gautam says So's calculations are some of the best in the industry, but they aren't bulletproof.
You know, when Hurricane Katrina hit, his portfolio lost 3%. So he has his down years. You know, if there's a big catastrophe and he's holding cat bonds linked to that, he will suffer a hit, just like any other investor.
And Gautam says the way some cat bonds are structured also means that investors can be on the hook for less rare weather events, what are called secondary perils.
You have a lot more mid-size natural disasters. So flooding, wildfires, tornadoes, and thunderstorms. Very often an insurance company will take a hurricane and package it with secondary. So they'll say, here's a cat bond. It covers a hurricane, but it also covers floods and it also covers wildfires. So as an investor, if you buy this cat bond, you know about the earthquake stuff. You're quite confident you have got a handle on the risk there. But the stuff on floods, the stuff on wildfire, you have much less certainty about. So when you take on that cat bond, when you buy it, you're taking on risk you don't fully understand.
So instead of predicting Hurricane Katrina, so could be predicting a thunderstorm in New York City.
That's right, exactly.
So my last question, Gautam, if So has a better model to predict these natural disasters or the risk levels of these natural disasters using a lot of data and a lot of know-how and technical expertise, this seems like information that governments and cities might want and that residents might want. It could save lives, help people anticipate devastating losses. Is buying and selling cat bonds really the best or the only use case for his risk model?
I think that I would say that cat bonds provide a very important service in that they help insure people against catastrophic risk when traditional methods of protecting you, such as insurance, aren't available. Last year, less than 1/3 of the $380 billion in global climate losses was covered by insurance. So the developing world, poorer countries are, we know, really at high risk from catastrophic events driven by climate change. They have very little insurance. But a cat bond could provide that. So the World Bank right now has about $1 billion in issued outstanding cat bonds for poorer countries, and it expects to increase that to about $5 billion. So I think cat bonds will increasingly play a role in helping to sort of bridge that gap a little bit.
This is The Big Take from Bloomberg News. I'm Sarah Holder. This episode was produced by Adriana Tapia. It was edited by Caitlin Kenny and Sharon Chen. It was mixed by Ben O'Brien. It was fact-checked by Naomi Ng. Our senior producers are Naomi Shavin and Elizabeth Ponso. Nicole Beamsterboer is our executive producer. Sage Bauman is our head of podcasts. Thanks for listening. Please follow and review The Big Take wherever you listen to podcasts. It helps new listeners find the show. We'll be back tomorrow.